Hello, in this video we'll be going through enacted tax rates. We've heard this before, but I'll just say it once again, that the revenues and expenses from a company's income statement may be different than the revenue and expenses recognized on the company's tax return, which is how they calculate their taxable income and determine how much tax they need to pay. There are two types of differences. There's permanent differences and there are temporary differences. We've also learned from previous videos that the temporary differences arise just because there's tax rules as to when you can recognize the revenue and expenses that may be different from when you can recognize them for financial reporting purposes. That should have like a space in there. So the issue for tax purposes, it's not whether an amount is taxable or deductible, but it's actually when can you take that deduction, or when do you have to recognize that revenue might be different than financial reporting. And when that happens, temporary differences arise, and either a deferred tax asset is recorded for future deductible amounts, and a deferred tax liability is recorded for future taxable amounts. So when we record those future deductible amounts or taxable amounts, we take the amount that we will have either as a deduction or income in the future, right? And we multiply it, we take that amount, and we always tax affected. But we should always be multiplying it by the currently enacted tax rates effective in the year where those temporary differences reverse. Up to now, all we've seen is when the tax rates are the same year after year. However, that's not always the case. Sometimes there's tax law that's passed. That's what it means by enacted, that the tax law has passed. It's not anticipated tax law. It actually has to go through the government and pass. And so sometimes a tax law changes the tax rates in the future. And when that happens, we have to record those deferred tax assets and liabilities at those new enacted tax rates. We're going to go through an example. I'm just going to show the entire example here where we have pre-tax accounting income for $185 million. Included in that 185 is municipal bond interest revenue, which is not taxed ever, so it's a permanent difference. So we remove that revenue, and there's some installment income. There's 80 million of installment income in the 185 that we are not going to recognize for taxes revenue on the tax return in 2027, but it will be recognized when that when the company receives the cash in 2028 for 20 million and 2029 for 60 million. So we calculate our taxable income as $100 million times the enacted tax rate for 2027, and we have an income tax payable for $25. So we're going to credit income tax payable $25. Then what we do is we look at our future taxable amounts of 20 and 60 is 80, and our enacted tax rate is 25%, and we record a deferred tax liability for that amount for $20. And then we plug income tax expense to make the journal entry balance. This should already be familiar to you, and I actually went through this exact problem in the permanent differences video towards the end of it. So if you're not familiar with this, then you can go watch that video. Or if you're not familiar with how deferred tax assets or liabilities are recorded and what they are, there's 4 separate videos dedicated just for that. So I encourage you to go watch those. So for this example, we've tax affected our deferreds that are going to occur, that we're going to have to recognize as future taxable amounts in 2020 and 2029 at 25%. However, what if in 2027, right, When we know that we're going to get the $60 million in 2029, probably because we have some sort of contract signed, what if in 2027 they passed a law, or we know about a law that has been enacted, a newly enacted tax law that changes the tax rate in 2029 to 30%? Well, we have to record our deferred taxes at the rate that we have to record it at the tax rate at the rate that it will turn during that year. So if we know that the 2029 tax rate is going to be 30%, then we need to record our deferred tax liability at the 30%. Now, since in 2028, the tax rate will remain at 25%, then we will record the portion of the deferred tax liability that will turn in 2028 at the tax rate for that year. So our calculation for current income tax payable is the same. We're still, step one is taxes payable for $25. However, our ending deferred will be, we'll take the $20, right, that will recognize as income in 2028 times 25%, and that's $5 million. And then we're going to take the income that we're going to recognize in 2029 multiplied by the enacted tax rate at that time, for that year, I should say, and that's $18. So our ending deferred is $23, ending deferred tax liability. And that's where you are going to record our deferred tax liability at. And again, our income tax expense is the plug. So when tax rates change, any existing tax liability or asset must be adjusted to reflect that change. So when it says existing tax, it's like the existing deferred tax liability or deferred tax asset has to be reconfigured to reflect the newly enacted tax law. I cannot emphasize the word enacted enough. If it's anticipated, if it's just waiting in Congress, waiting to be passed, or the Senate, or it has not been signed into law, then you do not change your deferred tax assets to reflect that new tax rate. It's only once it becomes law. So now, once the tax rate is enacted, right, in the year that the tax rate becomes law, at that point, that's when we have to adjust our balances, our ending balances for our deferred tax asset and liability, and that adjustment will affect the income tax expense in that year. So in our calculation, if in 2027 we knew about this 30% coming into effect, then in 2020 that it will be enacted in 2029, then we would have to look at all of our deferred tax liabilities and all our deferred tax assets that are going to turn in 2029 and later, right, and past 2029, and readjust their ending balances to be tax affected 30%. And we're going to go through an example of how to do that. But a significant tax law changed in December of 2017. Congress revised the federal tax rate, dropping it from 35% to 21% starting in 2018. So this was a huge law that was passed in 2017, because up to that point, for federal tax return purposes for corporations, their tax rate was 35%. And I don't know how long it had been 35%, but I'm going to go with at least 20 years. It had been 35%, and then Congress dropped it to 21%. And at that time, all the companies, all the corporations had to change the value of their deferred tax asset to adjust it to be tax affected at 21% instead of 35%, because it was going to be turning, those deferred tax assets and liabilities would be turning in 2018 and later. So they had to readjust all of their deferred taxes. So one example is Citigroup. And Citigroup had a huge net deferred tax asset. And when I say net, it means they looked at all of their deferred tax liabilities and all their deferred tax assets. And when you add them up, it was a net deferred tax asset balance, which is a debit balance. right? And they had to readjust it from 35% down to 21%, right? And so they had to reduce the balance in their deferred tax assets. So they had to reduce their DTA. And so if we're going to reduce our DTA, we're going to credit our deferred tax asset, and the debit goes to income tax expense. And they had to do this for $22.6 billion. So they had to reduce their deferred tax asset by $22.6 billion, and oops, 22.6 billion, and they had to record income tax expense for that amount, and an expense decreases your earnings. So in 2017, in the fourth quarter, Citigroup had a huge expense for $22.6 billion because of this enacted tax law change. So that's just to give you an idea of how significant these tax laws can be, these tax law changes can be. Let's go through an example. Late in 2027, Gladco has future taxable amounts. So future taxable amounts tells me it's a deferred tax liability of $1 million and a tax rate of 39%. We're also told that tax rate of 39% includes a federal tax rate plus the state tax rate. So any corporation, every corporation has to pay federal taxes, and then in addition to that, they have to pay state taxes for any state that they're doing business in. So Gladco has a deferred tax liability for $1 million at a tax rate of 39%, and it has already recognized a deferred tax liability of $390,000. This just tells us that their starting balance in their deferreds, when we're going to have a tax rate change, their starting balance in their deferred tax liability is $390,000. Gladco then learns that Congress has enacted a tax law decreasing the tax rates for future years from 35% to 21%, meaning that Gladco's total enacted future tax rate for federal plus state has dropped from 39% to 25%. So let me just go through that math really quick in case that doesn't make sense. Their tax rate, their old tax rate, was 35% for federal plus 4% state. And so their new tax rate now is 21% for federal. The state has not changed. So it went down from 39% to 25%. So let's see how that's recorded. I started off with a deferred tax liability of $390,000, and a liability, their normal balance is a credit balance. And now I have to adjust that ending balance. That $1 million is gross, meaning it's not tax affected. And now the new tax rate is 25%, because that is the tax rate that when we eventually have to recognize this $1 million into our taxable income, the tax rate at that time will be a combined federal and state tax rate of 25%. So in order to make the deferred tax liability reduce from $390,000 to $250,000, we need to debit deferred tax liability for the $140,000, and the other part of that journal entry goes to income tax expense for $140,000. Same thing if your net balance is a deferred tax asset. So this is the same facts, except now that the company has future deductible amounts of $1 million. So the normal balance for deferred tax asset is a debit. So they started with a deferred tax asset of $390,000. They need an ending balance of $250,000 because it's going to get tax affected 25%. So now they have to credit their deferred tax asset by $140,000, and the debit goes to income tax expense. Let's do a concept check. Dutch Bakers has a $100,000 deferred tax liability that will create taxable income in 2030. Dutch established the deferred tax liability in 2027 when the tax rate was 25%. What is the amount of future taxable income the Dutch will incur in 2030 associated with the deferred tax liability? So this problem gives you the tax affected amount, and it wants to know what is the actual future taxable income, meaning the gross amount. So in order to figure that out, we need to take our tax affected deferred tax liability of 100,000 and divide it by the tax rate that it is. This is tax affected at 25%. So we have to take the 100,000 divided by 25%, and then we know our future taxable amount is 400,000. That's how much future taxable amount we will recognize. That's part one of this problem. Part two, it tells us that so that was in 2027, tax rate was 25%. And in 2028, the tax rate enacted for 2030 was increased to 30%. And it wants to know in 2028, when that change happened, right, that when that tax law got enacted, what is going to be the effect on the income tax expense amount. So we have a $100,000 deferred tax liability, which is at 25%. And then we know that the gross amount of that is 400,000. So we are going to take the 400,000 times the newly enacted tax rate of 30%. So we have to true up our deferred tax liability from 100,000 and increase it to 120,000. And by doing that, we have to credit deferred tax liability, and then the other side of the entry will be a debit to income tax expense. So the answer will be C. I just want to clarify or reiterate one of these points, is that in the year that the tax law becomes, that the new tax rate becomes enacted, that is the year that the future deferred tax assets and liabilities that reverse in the year where that there's going to be a new tax rate. In the year that the tax rate is enacted, that's when you record this entry. That's when you true up your deferred tax liability at that point in time.